stalling out at all-time highs. 30 minutes until the start of trading. I'm Katie Greifeld.
I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, that rally hits a wall near record highs as traders take stock of President Trump's first few days in office, also digesting a fresh round of earnings, from a surprise loss at American Airlines to disappointing guidance over at Electronic Arts. Plus, Elon Musk and Sam Altman clash again, this time over that $100 billion AI effort hyped by President Trump. All of that and more coming up, but let's take a look at where markets are trading. Like I said, 30 minutes until those bells ring. You can see there's red on this screen behind me a little bit when you take a look at the S&P 500, a little bit more when you take a look at big tech right now. The NASDAQ 100 down about 0.5%, and even a sell-off when it comes to the bond market, a slight one. 10-year Treasury yields currently higher to the tune of 1 basis point. But Sonali, we're back above 460.
That's exactly what I was thinking. It took a few days to get there, but we are there once again. We're also watching some stocks, as Katie was talking about. American Airlines now down 4.3% after forecasting a surprise loss in the first quarter. We're also looking at Electronic Arts, down a whopping 17% pre-market. The video game company cut bookings guidance. GE Aerospace, though, is higher after results topped estimates, and the company announced plans to buy back $7 billion of stock. GE up 7.5%. That buyback story, Katie, is going to be a big theme of this earnings season.
Yeah, absolutely. And I want to focus in on American a little bit and contrast that with what we saw from GE Aerospace, because American Airlines bucking the trend in a bad way. We actually saw relatively bullish outlooks when you think about what we heard from United, from Delta. Not the case when it comes to American, but there are some green shoots, you could say, when it comes to the supply chain. GE Aerospace actually set to open at an all-time high. It definitely helps, like you mentioned, that buyback. Also raising the dividend by 30%.
Totally fascinating. If you look at the S&P Industrials Index, you do see United. You see the GE companies doing much better. They're among the best performers. That chart that showed United Air over the last 1 year up 166%. Just how much American has lagged is pretty staggering, and you have to wonder what that means for competition heading into this year.
Yeah, absolutely. Management matters. And just broad brushstrokes, I think industrials, utilities going to be some of the most interesting stories of 2025. Let's unpack it all now with Ben Gutteridge. He is investment director over at Invesco Investment Solutions, joining us now. Ben, it's great to have you with us. And let's talk at a sector level. Of course, so much attention has been trained on big tech, but you have a lot of movement when it comes to industrials, utilities, like I mentioned. And then you have healthcare, which just can't seem to get out of bed. What's your read when you take a look at all 11?
Well, I mean, it's hard to, very nice to be here. It's hard to get too bearish on the sort of that loosely defined tech sector. Valuations, of course, a bit of a challenge, but that has been levied at them frequently in the past. And of course, the earnings are just so impressive for those businesses. But yes, perhaps ripe for a bit of profit taking. I think financials look like a really interesting sector. Enjoyed a good run. Valuations not so appealing as they were as a result. But of course, with a resilient growth backdrop, interest margins as a function of higher interest rate environment, deregulation. I think there is a reasonable, there's a nice balance there. There's a nice complement between financials on the more sort of cyclical element and technology, AI as a more sort of secular, structural long-term theme. So I think they work nicely together.
If you have financials and technology, I am still wondering about the other sectors, because in this week of earnings season, and the big ones come next week, we have started to hit a bit more of a wall. We had blowout earnings from the likes of the big banks, even better earnings this week when you think about the other financials that people were worried about, seeing a significant stock price appreciation. But then you see what happens with American, and then you see some weaknesses in guidance at other companies like Electronic Arts. And do you start to worry that perhaps that earnings strength isn't everywhere?
Yeah, no, I think that's a very reasonable observation. Well done. Sorry to be. I would agree with you on all of that. But I mean, I think if we think about sectors, of course, there's idiosyncratic stories, which means active stock pickers can make money in any market. But if we're thinking about the macro sort of backdrop, as I sort of tend to do. You think about growth being resilient, you think about inflationary pressures being maintained, and an interest rate environment where, you know, rates are sort of higher for longer, very few interest rate cuts, if any, this year. Then you're thinking about some of those defensive sectors, not quite bond-like, but you think about utilities, consumer staples, maybe they wouldn't have such a good time of it. So certainly active stock pickers can make their mark, but from a sector perspective, I think technology, financials look good, perhaps utilities, staples looking a little less interesting.
Well, let's talk about those stock pickers and how much attention you need to be paying to the C-suite right now. Because to bring up the example of American again, you think about the strategic blunder that they had when it comes to work travel specifically. And it just feels like there's so many idiosyncratic stories right now, even within these sectors. How much does management actually matter here?
Well, management, of course, matters, and you can pick out any sort of single story. But I just don't think the management quality throughout the companies in the S&P 500 is rich pickings there. Some of the highest quality management, the innovative nature, the ambitious nature. You know, I don't get sort of troubled as a sort of a macro investor by the management inhibitants. Of course, you'll see reckless decisions from time to time, but we sort of think many of the sectors have sort of learnt from those decisions in the past. And I just think you're sort of well set up in US equity investing at the moment, such that management or reckless management decisions shouldn't inhibit you from investing.
You know, Sonali, it's really interesting to hear Ben say that, because you think about what happened last year, the purging of the C-suite at the executive level. You think about Starbucks, CVS, for example. There's a dozen others, but from the macro perspective, maybe not as important.
Maybe not, but that's also because of that concentration risk. And it brings us back. Matt Miller's not here today, but he would say next week is the only week of earnings that matters, right? And if next week is the only week that matters, Ben, how much do you look at that concentration risk that's in the equity market and say, I'm going to play into that, or I'm going to find a place to hide?
Well, I guess neither. I'll be sort of trying to thread the needle a bit there. I think it's appropriate to be, depending on how you manage your money or have your assets managed for you, to be thinking about having a modest underweight to that concentration risk at this time. But I would sort of emphasize the idea modest, you know, that could be levered that I'm a coward. I would concede that's a reasonable accusation. But as I say, repeat, that these are just such great businesses that are driving this concentration. But with US economic resilience and, you know, this sort of growth agenda that we're seeing, we could see a broadening out, and would anticipate a broadening out of earnings, and for a bit of a sort of catch-up trade rather than catch down.
Ben, we would never accuse you of being a coward, but let's talk a little bit more about that broadening out, because it broke a lot of hearts, especially towards the end of 2024. And if you're scared of concentration, what do you do here? Do you nibble at an equal weight index or something else?
Well, I think an equal weight index is a very useful strategy at this time. But of course, if you have very high concentration, an equal weight index has greater tracking error, is much more distant from a sort of typical market cap weighted index. So we would promote that idea, but you just have to have that in your mind, that there's a lot more active risk in an equal weight index, given the sort of concentration risks that prevail. And as I say, I think having a little bit more sort of cyclical exposure in the portfolio, that again would take you away from the market cap risk, given that sort of dominance of tech, things like financials, maybe some industrial names in there as well, perhaps a little bit more small cap, given the regulatory backdrop and the growth platform that we see ahead of us. Looks very interesting. But again, we're sort of not pushing too hard, given the quality, the impressive earnings performance of those stocks that are driving that concentration.
You know, I want to pull out for a minute from the stock market story to the macro story, because we are still getting economic data under the surface, even in a very busy earnings season. And the data from the jobless claims this morning showed that recurring jobless claims are at the highest levels in 3 years. You have less hope in the market for potential for subsequent rate cuts. If you're in the Neil Dutta camp, right, Katie, you can see more cuts being priced in because you worry about that labor market. Where do you stand on that spectrum?
Well, I would say these things are fraught to error in forecasting, but as it stacks up at the moment, it looks as though the job market is cooling, but cooling at a very modest rate. But I know these things can turn quite dramatically, so we have to be alert to that risk. We are in an interest rate regime that we consider restrictive, so any new financing, rolling over of financing, is going to be more punishing for the borrower. So there is a gradual tightening on the economy, and therefore gradual cooling of the labour markets. But I say, given the sort of growth initiative agenda of the administration that we're seeing, the health of the consumer, the balance sheet strength of the consumer, again, we would anticipate labour market cooling to maintain that only sort of modest pace. And therefore that would sort of support risk taking in like the likes of equity markets and such.
All right, Ben, got to leave it there. Really great to get some time with you. That is Ben Gutteridge of Invesco. Meanwhile, I take a check on futures right now. About 20 minutes until the opening bell, you can see not too pretty out there. The S&P 500 down by about 0.1%, and it just gets worse as you go on. The NASDAQ 100 off by about 0.5%. It certainly doesn't help that NVIDIA is down about 1.6% right now, and the small caps taking a hit with your Russell 2000 down by about 0.6%. Now, coming up, more on the single stock picture because EA lowered its booking outlook, and you can see stock is taking a bath right now. Details next. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. Saudi Prince Mohammed bin Salman told President Trump that he's willing to expand investments and trade with the U.S. by at least $600 billion. That's according to the kingdom's state-run news agency, and the commitment is large even by the standards of oil-rich Saudi Arabia. And the Pentagon is deploying 1,500 more troops to the southern border to comply with President Trump's declaration of a national emergency. Trump's acting defense secretary said he had also approved the use of military aircraft to assist with deportation flights of more than 5,000 illegal aliens detained by Customs and Border Protection. And a new study finds adults with ADHD, attention deficit hyperactivity disorder, are dying at an earlier age on average. Men with ADHD live 6.8 years less than the rest of the population, and that deficit grows to 8.6 years for women. That's according to an analysis of electronic health records from more than 300,000 people in the UK, Katie.
Well, let's make a hard pivot here and talk about video games, because we're watching shares of Electronic Arts this morning. The stock plunging after projecting weaker revenue from in-game purchases. EA pinned most of the blame on its soccer title, that is EA Sports FC 2025. That was released in September to mixed reviews, but Dragon Age also disappointed as well. Let's break it all down with Bloomberg's Jason Schreier, who covers the video game industry. And it seemed like sports helped Netflix out in a big way. Can't say the same thing for EA, though.
No, it was a rough year for EA's soccer title. Part of it is year-over-year comparisons. I was just reading a note from analyst Doug Kreutz at TD Cowen, who was saying that they appoint the decline to tough year-over-year comparisons and marketing spend. The marketing spend for this game was a lot bigger last year, but it's been a rough transition. EA recently got rid of the FIFA branding. They decided, hey, we don't want to pay FIFA anymore for this license to call our soccer games FIFA. And they switched to this kind of clumsy EA Sports FC title. And although last year's game seemed to perform well despite the name change, this year's did not.
Well, Jason, that was going to be my question just about this. Does that decision look like a mistake now in hindsight, given how prominent that FIFA branding was?
I don't know. I think it's still too early to tell. EA said in the prelim results last night that the big downturn here, the big hit here was in live service revenue. And what that means in kind of non-gobbledygook is the amount of money that players are spending after they buy the game. And the soccer series that they have is very contingent, the success of that. And a lot of the revenue that comes in from that is people not only buying the game, but also spending money on these kind of card packs and players that they can buy after they are already playing. And the fact that revenue is down, I believe it was an almost at least 10% swing, because they had estimated a mid-single digit growth, and instead they switched that to a single digit decline. The fact that that was such a plummet is bad news for them, and it remains to be seen if they can get that fixed in this game and then in next year's entry.
So that's the story on soccer. I do want to talk about Dragons, though, because you write that Dragon Age, the Veilguard, that came out in October. It reached 1.5 million players during the quarter, but that was missing expectations by about 50%. What happened there, Jason?
Yeah, that's a huge hit. Not as significant as far as EA's overall financial picture as the sports game is, but still a pretty big hit. It's not often that games miss by 50% of expectations. I think there are a lot of factors here. The game itself was a little bit polarizing. It was a 10-year gap between this entry and the previous game, and so there might have been a lot of just kind of waned interest for the Dragon Age franchise. BioWare, the studio behind it, has had a string of critical misses. Its last two games, Anthem and Mass Effect Andromeda, were both critical and commercial flops, and the studio has really lost a lot of player trust as a result of that. But also, I mean, big picture wise, the video game industry is facing some serious headwinds. A lot of people are not buying games, and there's some big picture, really interesting trends I've been watching for the last few years. Kind of the short version, one of the biggest reasons is, well, I'll just say Fortnite and games like it, because a lot of people are just playing the same games that they've been playing for the past 5, 6, 7 years, and they're not buying new ones. So that has been a big factor as far as players spending. Holiday season, big new titles are not getting the same kind of market saturation.
It's great context. I also want to do some analysis with you here, inter-industry, because if you look at EA, for example, versus Take-Two, over 1 year, you have a stock price appreciation of EA of less than 7%. That's more than 14% of Take-Two. Of course, both lag the S&P 500, but you do see divergence there. And if you did it over 5 years, it's actually worse, that disparity. So what are EA's rivals doing that it's not?
You know, Take-Two is in a different sphere of existence, because GTA 6, which is Take-Two's game that is currently announced for fall of this year, although I wouldn't be surprised if it slips, that is going to be the biggest thing on the planet. That might be analysts and pundits and journalists like myself are expecting that to be one of the biggest entertainment launches, if not the biggest entertainment launch of all time. So all of Take-Two's trading and pricing, it is all just almost entirely based on when people expect that game, how people expect that game to do. It's going to be earth-shattering for the video game industry, and a lot of other companies are looking to that to kind of rise all tides and get a lot more people playing in general, and hopefully boost the health of the industry. So I don't think you can really make a one-to-one comparison. EA is a lot more dependent on their kind of regular meat and potatoes franchises, including the sports franchise, and I think it's a really big red flag. I would certainly be worried if I were in Redwood City right now about that underperformance of the EA. Man, I still say FIFA, the EA Sports FC. It really is a mouthful. EA Sports FC title.
Yeah, say that 5 times fast. Jason, we have less than a minute left, and I have a little bit of a wild card for you. Did you see that Elon Musk online admitted that he had some help reaching the top levels of games such as Diablo TV and Path of Exile 2? I'm just wondering what the reaction to that has been.
I did see that. I mean, nobody's shocked, because he claimed to be one of the best players in the world and has spent like thousands of hours playing these, while he's also running 6 companies and flying to Mar-a-Lago every day. So it seemed unlikely. What I'm curious about is, would a company like Blizzard, which runs Diablo, risk banning his account? Because technically that is against the rules. You should be banned if you're if you're paying people to run your account for you. That is not allowed. So I wonder if companies will risk the wrath of Elon Musk by banning him from their games.
Yeah, that would certainly be a political statement at this juncture. Jason, great stuff. Really great to get some time with you. That is Bloomberg's Jason Schreier. Jason, of course, is also the author of the book Play Nice: The Rise, Fall, and Future of Blizzard Entertainment. Now, coming up, American Airlines tumbles after forecasting a surprise first quarter loss. We'll dig into those results later this hour. This is Bloomberg. Welcome back to Open Interest. Let's take the pulse of these futures. Of course, minutes away from that opening bell. We're coming off of 3 straight days of gains. We almost hit record highs yesterday on the S&P 500, and what goes up must come down at least a little bit. The S&P 500 down about 0.1%. The Nasdaq 100 down 0.5%. We do see some pain in the chip sector right now. You can see that weighing on your big tech benchmark. The small caps, we have a slight rise in treasury yield. We're back above 460 when it comes to that 10-year benchmark treasury yield. And as such, the Russell 2000 down about 0.6%. It feels like we've taken our eyes off the bond market a little bit this week, of course, with President Trump taking office back again. I wonder, of course, as we head into Fed week next week, whether that's going to become the conversation again.
Time to bring it back. We're at 465 nearly. It's not too much of a move today, but over 2 days, you're up more than 7 basis points on the 10-year. You're now at 430 on the 2-year as well. So even a little bit of a lift on the shorter end of the curve. And to your point, small caps underperforming because of it. Another interesting thing about the small caps is those small businesses are where all the excitement is in the Trump administration, not just because of where, or despite rather, where yields are going, but what happens with tax cuts? Is that really going to help the small business sector?
Also tariffs, too. The idea is out there that, of course, as manufacturing and spending power shifts domestically, that'll help some of these small companies that really don't have that international exposures. There's all these great bull cases out there, and it's just not necessarily translating through into the stock market, but we'll have to see.
How much you hear the dollar word is what I wonder in the next set of earnings. Now, coming up, we're less than 4 minutes to the opening bell. We're going to discuss the moves with Aoifinn Devitt of Moneta. She's the chief global market strategist there. Don't miss it. This is Bloomberg.
All right, we are moments away from the start of trading, about 20 seconds to be exact. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. This time yesterday, of course, we were talking about all that enthusiasm in the markets, in big tech, over that AI pact that was shepherded by Donald Trump, $100 billion of investment. Now you're seeing some of that euphoria fade a little bit. We got some reality checks on the earnings front, of course. We have a blackout when it comes to Fed speak. So we're looking for the next catalyst right now. You can see, though, at the 2 stock exchanges, people are clapping. There's a lot of excitement down there. But if you switch up the board and take a look at how we're doing in the first few seconds of trading, it's none too pretty. You're seeing yesterday's action, of course, right now. And you had that big rally in the Nasdaq 100. It's faded and then some today. The Nasdaq 100 down about 0.5%, 0.5% if you want to be fancy. Of course, the chip makers in the hurt locker a little bit today. The S&P 500 faring a little bit better here, down by only 0.1%. There's a lot of daylight between now and 4 p.m., so we'll keep a close eye on that one. But the Russell 2000 also seeing some pain this morning, down about 0.5%. We are seeing that slight rise in bond yields. We're back above 460 on the 10-year treasury yield. A quiet climb, but making itself known in the small caps. Let's take a look under the hood here. I mentioned those disappointing earnings, and you can see that in American Airlines. Lower after unexpectedly forecasting a first quarter loss. That's in contrast to the more bullish outlooks we've seen from rival airlines in the past few weeks. And you can see that surprise in shares right now, currently down by almost 9%, Sonali.
We'll dive more into that one. Serious surprise there. Electronics arts, even a bigger surprise. You're watching it down more than 16% as the market opens. The video game companies missing forecasts after 2 of their most recent games failed to meet expectations. Tough blow in what has otherwise been an exuberant earnings season. But also looking at chip stocks falling. If we flip up the board here, results from Korean memory chip maker SK Hynix failed to impress. And it's bringing down NVIDIA, Micron, and ARM to the tune of 1.8% for NVIDIA. Micron down even more than 4%, and ARM down 5.9% nearly, Katie.
All right, let's broaden out this conversation now with Aoifinn Devitt. She is Moneta's chief global market strategist, joining us now. And Aoifinn, it's day 4 of Donald Trump's second administration. We've seen a lot of action when it comes to immigration, AI, tariffs. We've heard JP Morgan is setting up war rooms to examine all these executive orders that are coming through. How are you separating the noise from the actual signals here?
That's a great question. You said it. There has been a lot of action, this flooding of the zone of all kinds of executive orders, tariffs one day, no tariffs the next, or a more lenient attitude to tariffs one day. It's actually a lot to digest, and markets abhor uncertainty. And as you can see with this on again, off again risk sentiment, it's been a very difficult market to navigate. And we do know that a lot was priced in, and we certainly thought this was dollar dominance. That was the code word of last week pre-inauguration. And now we're actually seeing some dollar give back, as it does seem that not every trading partner is essentially a sitting duck for whatever trading policy the US wants to impose. So there is a sense that perhaps we maybe oversimplified the situation going into the new administration. So quite a lot to digest this week.
The on again, off again risk appetite out there seems to be a difficult thing for a lot of investors to navigate, as you had mentioned. The S&P 500 yesterday closed less than 5 points away from a record high. And today you're watching that risk off moment once again. What would cause you? What do you need to see definitively to be risk on once again?
We need to see clarity around regulatory change, around tariffs, around perhaps working with the Federal Reserve in terms of knowing that they will be mutually supportive in terms of the administration. There won't be rhetoric against them, because that's exactly what the Federal Reserve has worked so hard to do over the last 18 months, is to restore its reputation, to be very clear, very data dependent, and have no surprises. So in order to be firmly risk on, we need to know that many of these concerns, which are keeping investors up at night regarding inflation, the direction of the Fed, what's going to happen with tariffs, what that would do to the US economy, all of that needs to be put to bed a little. And all we need for that is clarity.
Clarity. Let's layer that conversation and that need for clarity on top of the earnings picture that we're getting so far. It's early yet, but you think about Electronic Arts sinking by 18% at one point. That is the biggest drop since 2008. You also have American Airlines having a pretty painful morning as well. Is that a little preview of what to expect when we get deeper into earnings season, that if you miss, you're going to be punished in this market?
Absolutely. You named two sectors there, and we've seen a very similar sell-off, and we saw that in the obesity drug sector as well. So it's a very sharp sell-off, a sudden disgust perhaps, or a sudden concern around the frothiness. That is a symbol that markets are on edge and waiting perhaps for something to tip over. And we've seen that in certain sector by sector. Similarly, there will be differentiation within sectors. So that could be a good market for active stock pickers. They've been claiming that this is a good stock picking market for some time now. We haven't exactly seen that. It's all been about the index shares, and we've seen flows out of active managers as a result. But I do think that more differentiation is likely, but clearly no sector will be immune.
When you think about what we're going to see next week with the big tech earnings as well, how do you expect them to perform, especially after such a big run up? If Netflix was just a taste of outperformance, do you think the others can live up to the hype?
I think we have to put all this in context. Let's look at the inauguration at the beginning of the week. We saw this astonishing display of the tech titans side by side with the highest order of politicians. And we know that they have firmly a place at the table. They're optimistic. They are reining in some of their policies that didn't concur with the Trump administration's policies. And they're poised for exciting 4 years ahead. So I do not see anything. I think we know that they've been telegraphing earnings well in advance. We know they have the margins to justify it. We know they have the pricing power. And if there's uncertainty around regulatory developments, possibly around the regulatory eye that's on tech companies, again, we hardly heard anything about that in the executive orders. So I'd say they're feeling pretty optimistic at this point. Now, what we've seen in the chip stocks this week is a concern that perhaps too much has been baked into these prices. But I would say the tech companies are probably ones not to bet against at this juncture.
That's interesting. And I want to wrap that into the political landscape as well, because you think about Monday's inauguration, you had all the big tech CEOs there in a prominent way. I mean, you think about this antitrust, this regulatory overhang that has really clouded a lot of these big tech names. As an investor, how do you read the fact that you do have these tech CEOs seemingly cozying up to Trump? Does that matter to you, or is that something that maybe is more towards the fringes?
It matters in a very positive way, I'd say, just in terms of why are they doing this? They're doing this to clearly align their interests with those of the new administration. They want no surprises. They want to be inside the tent. And being inside the tent, I think, assures that there will not be negative or perhaps politically motivated attacks on their positioning. maybe no attempts to unbundle. I think it's very shrewd tactics on their part to get inside the tent. I'd say as an investor, you feel safer that way because you know there will not be a targeted, perhaps regulatory change. And I'd say now it's about closely watching just how well this marriage works out because it is a new one. It's a new set of chemistry, certainly a change from the first administration. And we've already seen with Doge that one of those leaders is gone. So there will be friction. These are big egos at play, a tendency to be competitive. We know that from the space race that we saw quite recently. So I'd say watch this space.
We're going to hold that thought on Doge, talk more about it later in the show.
I cannot wait, I have to say. That'll be fun.
It's been a lot of news, When you look at the Russell 2000, that's another thing Katie and I have been talking a lot about. You look at it from the November heights, and it's down almost 6% already. Part of that was fears around what you saw in terms of interest rates. On the longer end of the curve, a lot of these firms have a lot of debt. As we know, many of them are unprofitable. But this has been a big trade. This has been a hopeful trade, and it's been a trade that's been expected to do well under the Trump administration. Would you buy this dip, or do you think that there's still uncertainty in terms of performance there?
I would buy the dip, yes, because I do think it's been overdone. And also, we need to rebalance our equity portfolios at all times. So we still believe in a balanced equity portfolio between large and mid-cap and small cap, as well as also non-US and US. So we're still somewhat traditional in that respect. But I would say in terms of what's driving it, we can see that there is an expectation that America first would be good for those that are not dependent on international trade, that are not affected by a strong dollar, and perhaps don't have as much leverage. So we're not going to be subject to needing to refinance even at these still higher interest rate levels. So a lot was tailwinds in terms of small and mid cap, but they've just failed to deliver according to expectations. We still see a lot of the momentum behind large cap tech. As I mentioned, that's now almost a risk off trade in equities is to be large cap tech, even though it's volatile, even though it's well priced. And as I mentioned, the fundamentals support that. There's a little bit of reticence around buying into mid cap at the moment. It has been trailing. It's a more defensive type of sector. So I would say, yeah, yes, but in terms of whether I would buy in the dip.
All right, and to that point, I mean, you take a look at, it's early yet, Sonali, but the NASDAQ 100 outperforming, the Russell 2000 underperforming. It's a story we're pretty used to at this point.
We've been so used to it, and you have to wonder whether the earnings season can give investors something else to chew on. Bloomberg Intelligence, just reading this morning, said that they think healthcare is going to outperform. I know that's been a really exciting sector that you've been digging right into.
Yeah, and DataTrack, to that point, one of our favorite research shops out there, saying it's too cheap to ignore, but Aoifinn, we got to leave it there. Great to speak with you. That is Aoifinn Devitt of Moneta. Now coming up, airlines on the up and up, except for American, that is. More on that next. This is Bloomberg. Welcome back to Open Interest. You take a look at the stock market right now. Not too much change to report. The S&P 500 down about 0.1%. A lot of that weakness being led by what you're seeing in big tech right now. Their losses coming back a little bit. The NASDAQ 100 down about 0.4% right now, and it's a similar story if you take a look at the Russell 2000 down about 0.4% as well. We'll continue to track the movement there, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, Boston Beer downgraded from overweight to neutral over at Piper Sandler. The analyst citing slower than expected sales growth of Twisted Tea. Next up, healthcare software Viva double downgraded over at Goldman Sachs from buy to sell. The analyst cites competition from Salesforce and says that a fundamental recovery in the life sciences vertical is likely to be slow. Shares currently off about 4.5%. And finally, we have Netflix upgraded at Wolfe Research after its strong earnings report. The analyst says that the outlook buried long-standing concerns about a deep slowdown. Netflix adding another 2.3%, Sonali.
And in earnings news, we've been talking about it all morning because it's seeing a pretty strong dip here in the market. American Airlines forecast is a surprise first quarter loss, and it's braked from rival carriers that have been cashing in on unusually strong winter demand and pricier domestic fares. By contrast, Alaska Air forecasts a smaller than expected loss in the first quarter, and GE Aerospace announced a $7 billion stock buyback after topping profit estimates. You can see the dispersion there in all the stock prices. And joining us now to unpack it all, George Ferguson, Bloomberg Intelligence's senior aerospace, defense, and airlines analyst. want to just go right into what's going on with American Airlines because, of course, there's today's story. You're seeing the stock really fall the most here intraday since May of last year. They have underperformed their rivals generally, and you do have analysts weighing in, citing concerns about costs outside of fuel, in addition to other missteps in the recent quarter. What would you look into most in terms of what's going to matter for them in the year ahead?
Yeah, so I mean, I would start by saying I thought they had a really good quarter, right? And their revenue performance was as good as, if not better, than their peers, United and Delta. And look, I mean, I think, there's only 3 big full-service carriers in the U.S., and American made a misstep by trying to do a lot more direct bookings than, getting through travel agencies. They've changed that, switched back to taking more travel agency bookings. And I think you can expect that they're going to catch up, right? It's not like United and Delta are going to be able to run away with the business. Now, for 1Q, they're going to put less capacity into the marketplace. They just signed another labor agreement that's going to increase costs. So their costs are rising high single digits, where you've got United and Delta rising mid-single digits. Look, they said by the back end of the year, 2025, they'll lay in more capacity and they'll get those cost increases down to mid to low single digits. They'll perform probably as well as United and Delta. Again, they've got ground to make. They've been the underperformer. They've got ground to cover to get there. But I think that you'll continue to see them close that gap. But I don't think, again, United and Delta are going to walk away with this business.
That's really interesting, George. It sounds like what you're saying is basically this 9.3% plunge that we're seeing in American right now is a bit of an overreaction.
I think so. I do think so. Again, 1Q is going to look worse than the other 2, but I still think they're all 3 working in the same marketplace. They have very similar, routes and regions they fly to. It's going to be really hard again, I think, for American not to be able to catch up to rivals.
I also want to go to GE with you for a moment here, George, because you are looking at just a stunning capital return story in addition to what has been a very high-performing stock. In the past year, you're looking at shares up about 8.6% right now as well. How much juice do they have to really still take out of this performance story? What does the year ahead look like for them?
The delays in new aircraft deliveries from Boeing and Airbus have really sort of driven in the marketplace the need to fly older airplanes longer. And GE and the other engine makers, but remember, GE is the biggest and the best engine maker globally. They have really strong market share in narrow-body aircraft and wide-body aircraft, unlike their rivals. So they are really benefiting from this desire to fly planes longer, and therefore you need to maintain those airplanes. That maintenance business is very large margin business, and so I think it'll be a tailwind into the next year, into 2025 for sure. I think it starts to tail off into sort of 26s, 27 timeframes, but really long, these are long trends in this business. And so GE is really generating some great cash and really nice margins right now.
George, we thank you so much for your time and analysis. A lot of news in your sector this morning. That is George Ferguson from Bloomberg Intelligence. Now coming up, Elon Musk takes sole control over Doge as Vivek Ramaswamy exits. And we're going to look at the future of the department in our Wall Street beat next. This is Bloomberg. It's time now for the Wall Street Beat. Today, we're looking at the divorce between Elon Musk and Vivek Ramaswamy as it pertains to Doge. For more here, we are joined by Max Chafkin of Bloomberg, follows Elon Musk closely, and people out, people in. I'm also looking at this story this morning in the Wall Street Journal. Michael Grimes, who's a star banker at Morgan Stanley in the technology industry, big part of taking Tesla public, big part of Elon Musk buying X, might leave Morgan Stanley, go to Doge. Are they going to pay him?
I mean, look, if you're a deal maker, this is where all the deal guys are right now. So it makes sense in that way. I don't know. There are definitely a lot of sort of big names who are close to Elon Musk, sort of friends of Elon, who are providing, informal advice. Reading the Wall Street Journal's report, this sounds like
Mark
potentially
Andreessen.
a more formal role. Yeah, Mark Andreessen and David Sachs and others. So on the other hand, we're also seeing Vivek Ramaswamy, essentially out at Doge and running for governor. So it's a bit of a revolving door right now.
So two things. One, it's confusing that his name is Michael Grimes and not Grimes, the musical artist, who, of course, has given birth to several of Elon Musk's children.
He likes the Grimes.
That's true. That's true. It's an appealing name for him. Number two, when we say a job at Doge, is it really a job with a paycheck, or is it sort of on a volunteer basis?
There have been conflicting reports, even conflicting reports from Elon Musk and Doge. Initially, Elon Musk said it's going to be volunteer, you're going to have to work 80 hours a week. Doge, the Twitter account, which may or may not be an official government Twitter account at this point, has also listed actual jobs, it appears, in HR and finance and things like that. So my supposition is that there are going to be some people who are actually paid, but a pretty small number. It is a government efficiency commission after all, as well as a healthy sort of group chat. I mean, it seems like a lot of what Doge is, some of Doge is inside the government. Some of it is this kind of almost like political advocacy group, with Elon Musk's Twitter at the head, advocating for essentially Donald Trump's policies.
So if we look on average, just days into the administration, is Musk now closer or less close to Trump, given what he's doing with Doge? Because this was supposed to be an external body, not an internal government body from the beginning. At least that's what Ramaswamy wanted, according to the Journal.
Yeah, the conventional wisdom all along is like these guys their egos are too big, they won't be able to last. And that is not what we've seen in any way. Musk, according to reports, is working out of the West Wing right now. He was in the Oval Office when Trump pardoned Russ Ulbricht, the crypto-convicted Silk Road founder. So he is very close. There is no sign that they are falling out or anything like that. Although Musk is giving Trump plenty of reasons to potentially push him aside if he ever wanted to.
Well, let's talk about AI. And that AI JV that was announced yesterday or 2 days ago with the $100 billion of investment coming from SoftBank and OpenAI involvement as well. Sam Altman, Elon Musk famously don't get along. When we think about the future of the relationship between Musk and Trump, could this be a potential breaking point?
Possibly. If we were talking about this AI announcement, we would be saying, critics are saying that this $100 million or $100 billion or potentially $500 billion thing is just a marketing thing and they're never going to fund it. It's not going to create any jobs. Turned out yesterday, one of those critics was Elon Musk, who spent about half the day calling Sam Altman, quote, a swindler, calling the announcement, quote, fake, posting all of these tweets from, years ago where Sam Altman had supported Democrats, really undermining, President Trump's big infrastructure announcement in a way that felt kind of extraordinary, just given the fact that Elon Musk is in the administration.
Yeah.
And of course, as you say, Katie, that is the feud with Elon Musk and Sam Altman, which goes back all the way to the founding of OpenAI, the creator of ChatGPT. It goes all the way back to the founding. They are in litigation together. So I don't know. We're going to see this continue.
I do wonder if it means that Trump's relationship to Sam Altman, therefore, is going to become closer and closer, and whether that spells a little bit of trouble for Satya Nadella, who was not in yesterday's announcement.
One thing I'll say is Elon Musk has a point. It is not clear that this $100 billion or $500 billion is there.
Right.
And you are right. There is potentially, I suppose, a threat here to Microsoft. Although, again, it's not clear how much money is really behind this. So how big a threat, I don't think we know yet.
Well, it's really fun comparing who's in, who's out, how that might change. Max Chafkin, fantastic reporting as always. Meanwhile, a quick check on stocks. We're just about half an hour into the session. You can see the S&P 500 still down. Similar story across the indexes. Stick with us. We'll talk to Liz Ann Sonders of Charles Schwab Investments next. This is Bloomberg. All right, we are 30 minutes into a pretty soft trading day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today. And coming up, the rally that drove stocks to the brink of all-time highs hits a wall. We're going to get an outlook from Sonders of Charles Schwab. And President Trump addresses the World Economic Forum today, but he's not showing up in person like he did before. The CEOs of Blackstone and Bank of America are among those who oppose questions to Trump. But before he speaks, we're going to talk tariffs with the CEO of Genco and energy with investor Tyler Reeder.
All right, all of that and more coming up, but you take a look at where market stands right now. We could use a little bit of good news because the S&P 500, it's pretty much unchanged, but the color is red. We've gotten 3 straight days of gains, so a bit of a breather today. A bit more, though, if you take a look at big tech. The Nasdaq 100 down about 0.5%, and you're seeing that quiet climb in bond yields become a little bit louder this morning. The 10-year Treasury yield higher by about 4 basis points, back above 460, and that's where I want to go with Sonders. She is Charles Schwab, Chief Investment Strategist, joining us now. And there's been a lot of cross currents to start 2025. One of them is what's been happening in the bond market at the long end of the Treasury yield. And 460, it's a little bit below where we've been in recent weeks, but still, we're getting up there. How do you factor that in as you take a look at this equity market that has come so far already in 2025?
Well, you do have to factor it in. And for a while now, whether you look on a trailing 1 month or 6 month or 1 year or 2 year on a rolling basis, you're in negative correlation territory between bond yields as measured by the 10-year and equities. And I actually think that may be a sign of a different secular backdrop. You know, we had 25 years or so during the Great Moderation, where from the mid to late 90s up until the early part of the pandemic, bond yields and stock prices moved in the same direction. And that was because we were not concerned about inflation. There wasn't a lot of inflation volatility. So higher yields often meant stronger growth without the attendant concern about inflation. But a lot of people forget that the 30 years prior to the Great Moderation, the period from the mid 60s to the mid 90s, almost that entire period of time, the relationship was in inverse territory. And we're back in that inverse territory. And I think it's a sign, maybe not of inflation staying high in perpetuity, but more inflation uncertainty, more inflation volatility. And I think that will continue to be one of the key drivers for the equity market.
Do you think that's baked in, that uncertainty, to the equity market, given that we're so close to all-time highs? And do you think the earnings season that we still have ahead of us might still spell that inflation might be burning some companies at its core a little bit?
Yeah, I think, you know, we're still early in reporting season. Obviously, we're reporting fourth quarter, and not that it's an irrelevant statistic, but I think what matters more during this earnings season is the commentary from a forward-looking perspective, not just on earnings, which in general estimates have been trending a little bit lower for 2025, but where consensus sits right now, 13-14% growth in 2025, is predicated on record profit margins. The inflation backdrop and its outlook obviously comes into play. So that's what I'm paying at least as much attention to during fourth quarter earnings season, is the outlooks, not just in general for 2025, but that profit margin outlook. And again, those in not just inflation, but also moves in the dollar. Some of where we're seeing the biggest hits to consensus estimates on a going forward basis are the multinational companies that derive a larger share of top line growth from overseas sources. So moves in the dollar, which also directly ties to government policy announcements, also monetary policy issues, I think will be a key factor in helping sort of lay the land for 2025 estimates.
Well, I'm glad you brought up the dollar because we saw the effect of Forex in J&J earnings yesterday. Of course, we were talking about it with Lori Calvasina, just how much we're going to hear about currencies in the earnings period ahead. And Lizanne, I want to hear your take on whether how much it actually will hurt, because we've been batting around the idea that maybe companies will use it as a little bit of an excuse. It certainly seems convenient to do so.
Yeah, they might use it as an excuse. It's, you know, retailers often use the weather as an excuse. Maybe that's not the right descriptor, but that's how we often describe it. And I think there is some legitimacy in terms of, does it actually have a meaningful impact on the stock market? What you do find is that dollar moves, either up or down, have a bit of a higher correlation to estimate changes on the part of analysts. They have less of a correlation to how the stocks actually perform. But because we're in earnings season, I think there's a little bit more attention on dollar moves and the impact it has on estimates, even if it's a lesser impact on the actual stocks.
Lizanne, we really do have a bulk of the earnings really coming out next week. When we look at most of the big tech stocks, really putting forward not only what they've made in the end of last year, but they're going to give a bigger picture of what we're going to see in the year ahead, how much they're willing to spend. How do you think that investors are preparing for that? Are they as patient with CapEx spend, or do they just want to see more capital return at this juncture?
I think for now there is still some patience with CapEx spend, but maybe more importantly, CapEx intentions, because of just how much uncertainty there is right now with regard to government policy. Maybe a little bit less so on immigration because there's been some meat put on the bones of that, more so on the tariff front. From a more secular perspective, I think the CapEx cycle ahead looks very robust. I think, in fact, from a secular perspective, I think we may be shifting our economy to one that, relative to its own history, might be a bit less consumption driven, but relative to its own history might become a bit more investment driven. So that fixed investment portion of GDP lifting relative it's to a history, maybe at the expense of a little bit of a move down in consumption. I think that would be a good backdrop. But we're certainly not out of the woods in terms of the near-term uncertainty that might keep those budgets somewhat constrained.
Well, let's talk about how positioning wraps into all of this, because there was a really interesting report out from Goldman talking about positioning not being reflective of the current rally and may cause some fear of materially underperforming. And as such, you could see some of these big money accounts shift more aggressively into the stock market. But at least to me, positioning always feels like an inkblot test. It can be anything that you want it to be. What is your current read on whether this is a fully allocated market or not?
Well, so our world, our more than $10 trillion of client assets, for the most part, are all individual investors. So that's the world in which I live. I don't live in the institutional world of trying to gauge positioning from hedge funds or speculators. But what's interesting about the individual investor world is there's a pretty interesting and wide spread between attitudinal measures of investor sentiment and behavioral measures of investor sentiment. So AAII, American Association of Individual Investors, is probably the most well-watched, longest tenured attitudinal measure of sentiment. It tracks percent of bulls, percentage of bears on a weekly survey basis. And you have a pretty hefty spread in favor of a larger share of bears, a smaller share of bulls. From a contrarian perspective, that would be seen as a positive. AAII also actually tracks the equity exposure of their members, and the equity exposure is not far off of an all-time high. So a big difference between what, at least based on that measure, investors are saying and what they're doing. So I think there's more skittishness that shows up in that survey data. You're asked, what do you think? I'm a little nervous, but it hasn't translated into actions on the part of investors. So when analyzing that and positioning, you've got to listen to what they say, but you absolutely also have to watch what they're doing.
Lizanne, we thank you so much for your time today. Of course, that is Lizanne Sonders of Charles Schwab in the thick of earnings season, and a lot of political overlay to the trade these days, of course. But coming up, we're going to discuss the effect of Trump's proposed tariffs on the shipping industry in particular. We're going to bring in John Wobensmith, who's the Genco CEO, for that conversation. Stick with us. You're not going to want to miss it. This is Bloomberg. And now to high interest, a look at what's making headlines around the world. We're first looking at two new wildfires spreading quickly in Southern California. The Hughes Fire north of LA broke out yesterday. It quickly spread to 10,000 acres. The Sepulveda Fire started early Thursday west of LA near the Getty Center Art Museum. About 50,000 people were told to evacuate. And crypto's richest man, Binance founder CZ Zhao, is turning the former venture capital arm of Binance into a family office. It will be called YZI Labs. It will oversee about $10 billion of crypto-related assets, plus investments beyond crypto, to include AI and biotechnology companies. And Spanish-language film Emilia Perez leads the Oscars race, raking in 13 nominations. It's nominated for Best Picture and Best Director, but this year's Best Picture race is wide open, with The Brutalist, Anora, and Conclave all leading the betting markets. And President Trump will address the World Economic Forum virtually at 11 a.m. New York time. Earlier, Morgan Stanley CEO Ted Pick told Bloomberg what he thought of the environment so far under Trump.
I am positive because it is definitely a change in tone. It just feels like the overall framework is one where there's going to be more interaction between the public and the private sectors. What you guys were talking about the last couple of minutes, it can't be state actors alone, and it can't be private companies alone. So the fact that there's real dialogue building, I think that's a huge plus.
Okay, I actually have a lot to say about Oscar nominations, but let's keep going on politics because Secretary of State Marco Rubio is planning on visiting Panama as soon as next week. That comes amid President Donald Trump's calls to retake control of the Panama Canal. Trump is also threatening tariffs on Mexico, Canada, and China. Let's discuss all of this and the effect on the shipping industry with John Wobensmith. He is the CEO of Genco, joining us on set. Great to see you in person.
Yeah, thanks for having me.
Let's start in Panama. Of course, you have more experience than most of the audience listening right now with the Panama Canal. How does it actually run, and what do you make of this proposal?
Well, certainly we have a lot of ships that go through, both sides, coming in from the Pacific and going to the Atlantic. There is a very close relationship between the U.S. and Panama. It's probably our biggest Latin American partner from a strategic standpoint and a diplomatic standpoint. And you have to keep in mind that, I mean, the Panamanian currency is actually pegged to the U.S. dollar. So there is a very close economic relationship. The canal itself is run by the Panama Canal Authority, which is 100% owned by the Panamanian government. So that authority is collecting the tolls to go through and the fees, and they are also responsible for maintaining and the capex on the canal. And then the whatever is left, which is anywhere from $2 to $2.5 billion a year, which is a big number, but it goes to the Panamanian government.
The question I have, though, is from your perspective, as somebody who is very intimately involved with running ships there, do you think that there is a real threat here in terms of China's interest with the Panama Canal? And do you actually want to see any change there in terms of the U.S. interests in the Panama Canal?
Well, so let's just talk about China for a second. So we've all heard a lot about the ports that China owns on either side of the canal, and that is all true. China has invested in a lot of ports in Europe as well as Latin America, certainly in Asia. But they are just that, they are ports. They're goods that are coming into Panama. They are separate from the canal itself. There's no doubt that China is trying to grow their influence globally. We've certainly seen it in diversification of commodities. They have large projects on iron ore and bauxite that are happening in West Africa. And as I said before, they certainly are taking interest in ports around the world. So I can understand some of the concern. The Panama Canal is a very strategic asset, but as we see it right now, it is certainly controlled by the Panamanian Canal Authority. There is a separate board of directors. There is an advisory board. It seems pretty buttoned up.
Well, let's build on this conversation and talk a bit about tariffs. Of course, we've seen some levels and threats thrown around when it comes to China, Canada, Mexico, et cetera. And it seems like equity market bulls are happy to write those off as just negotiating tactics.
Right.
But your clients, do they have that same luxury, or do they have to plan around the potentials here?
Well, so I think everyone is really sitting back and trying to listen and understand what is going on. It's a little chaos theory, as I think we can all agree. The reality is a full-scale trade war, in my opinion, is not a good thing for anybody. However, smaller tariffs on certain goods, in terms of shipping, they could move trade routes around. There could be some volatility and disruption. That always tends to be a positive thing for shipping markets in general. And I think most of those tariffs will be passed on to onto the consumer, unfortunately.
Speaking of that as well, we've seen a lot of anecdotal evidence and data also that has shown that you've seen companies really front-loading here and stockpiling ahead of potential tariff policy. How are you seeing that play out?
Well, we have definitely seen stockpiling in China for grains, particularly on the soybean side, things brought forward. The other thing that I think we could possibly see is, you can look back to sort of 2019 era where Trump was negotiating with the Chinese. The Chinese put tariffs on U.S. agricultural products, both soybeans and corn. Okay, so then what did China do? They decided we're going to buy more from Brazil and a lot less from the U.S. It obviously hurt the U.S. farmers, so Trump did some subsidies to try to take care of that. But what I've realized after decades in this industry, goods find a way to get where they need to be.
Right.
And as I said, disruption does benefit freight markets in the end of the day.
Well, to that point, that goods find a way to get around the world, does the experience of the first Donald Trump administration, and of course what happened during the pandemic as well, are supply chains more flexible and more able to absorb sort of the impact of tariffs as a result?
Oh, absolutely. Whether it's containerized cargo or dry bulk commodities, which is what we do, or even the oil markets, there's definitely more flexibility. The management teams are much more adept, both on the commodity side and on the shipping side, in navigating, again, volatility and disruption.
I also want to talk about more disruptions around the world, because just recently, and this is as it pertains to the Middle East and the Red Sea in particular, you have had a sign of hope, I suppose, here in the Red Sea, where the Houthis have said that both U.S. and UK ships can safely take passage there, but there has been so much disruption. And you've even seen shipping crews here held for a long time, one held for over a year. Are you going to return to shipping through the Red Sea?
I do not see us returning anytime soon. We made the decision back in December of 2023 to not transit the Red Sea area and actually go around Africa. The way I look at it, and I can tell you just very quickly what happened at that time, we made the decision. We still had 2 ships that had to go through, and unfortunately one was attacked in early January. Fortunately, nobody was injured. But as I look at it, it's still a volatile situation in my mind. So to put our crew in danger where you're halfway down the Red Sea, you can't just turn around and go back. So
right.
I still think for the time being and the medium term, we'll continue to go around.
One question I have, too, is if you have uncertainty in the Middle East, you have this tariff uncertainty as well, what does this spell for inflation? Because when you see the disruption in shipping paths, we've seen that spell more inflation for consumers at the end of the day. Do you think that maybe there's something that a lot of Americans are not seeing in terms of what they can expect?
So certainly on the container ship side, we've seen an increase in box rates. Not our business specifically, but obviously we know a lot about this on a general basis. The dry bulk industry, which is what we do, there's been a little bit of an increase on freight rates, but it's been more on containerized cargo. I think the numbers of demand is up 12% just having to go around Africa in terms of containers, whereas ours is maybe 1% to 2%.
John, we appreciate you joining us here in studio, giving us a look under the hood here. That is Genco CEO John Wobensmith. Now, happening right now across the world, over at the World Economic Forum in Davos, Switzerland, Francine Lacroix of Bloomberg TV is hosting a panel about Saudi Arabia's economic shifts. You can watch that by going to Live Go on your Bloomberg terminals. This is Bloomberg.
Long-term view, prepared to take tough decisions, and be consistent and driving that. I think that recipe would work not only in Saudi Arabia, that recipe would work in Europe, in Asia, and everywhere else. I think.
All right, welcome back to Bloomberg Open Interest. A quick check on markets right now. Not too much movement to report. The lines are still going lower. The S&P 500 down about 0.1%. Big tech leading the plunge there, down about 0.4% when it comes to the NASDAQ 100. Some pain in the chip sector. Some pain, too, if you take a look at the bond market. The 10-year Treasury yield currently higher by about 4 basis points on your long end. The 10-year currently about 4.65 right now. That could be why you're seeing some pain when it comes to the small caps. We know that the Russell 2000, one of the big underperformers currently on the day. And Sonali, it's interesting. You think about small caps. One of the reasons I hear, we were talking about the bull cases earlier, one of the bear case is that you don't see companies, smaller companies, really go public anymore. And we had a great conversation with Kathy Wood on ETF IQ yesterday, and she made the point that she's hopeful that under the Trump administration, you might see some of those smaller, more innovative focused companies actually come to the public market because the regulatory environment has not been too friendly.
Yeah, there's certainly the hope for that. We haven't seen a whole lot of that yet, but yet we are only 23 days into the year and a few days into
only 23 days.
It was supposed to come hot and heavy, and it hasn't yet. And you have to wonder if a lot of the pipeline here is still for those highly levered private equity-backed companies rather than those high-growth, high-flying technology companies that have wanted to stay private, that have had more patience. Another thing I'm looking at today, too, the NASDAQ 100, you were pointing out how it's lower. Electronic Arts is still looking at a pretty steep decline. What is leading the index higher is still that of Netflix still feeling gains and Constellation Energy.
Yeah.
This is one of the more interesting trades because you are seeing on the year so far the S&P 500 also brought higher by that energy index. And it's because of these names that are playing in those traditional energy spaces as well as those more AI-friendly, even nuclear energy spaces.
Yeah, it's interesting to see this crossover between sort of old economy utility type names and more of the new economy hype cycle that you're seeing right now when it comes to AI power needs, sort of breathing life back into some of these energy names, these utility type names, extremely hot right now.
Although today, at least on the day, you do see the energy index higher by even traditional energy as well. It's been a choppy trade. Coming up, speaking of IPOs, we're going to instead talk about M&A. Talking about the cleanest, largest clean energy provider with Energy Capital Partners next. This is Bloomberg. The M&A boom is continuing across industries, particularly energy. Energy Capital Partners is selling Calpine to Constellation Energy to create the nation's largest clean energy provider. The deal is valued at nearly $16.5 billion, and you do have Constellation's own stock rising by more than 40% since the deal was announced. For more on the energy industry, we are joined by Tyler Reeder. He is Energy Capital Partners President and Managing Partner. ECP is a leading equity and credit investor across the energy transition infrastructure. And Tyler is on the board of Calpine. He sold this firm to Constellation, so has an intimate view here of the changing winds of this industry. First, maybe talk about the deal itself and how it came together, because it's a big deal to start the year, and certainly a large deal for the private equity industry that is waiting for deals to happen.
Yes. Well, this deal was a large take-private transaction in 2018. For us, it was by far the biggest endeavor we had taken on, but we had a strong conviction that there was real value in where it was being priced in the public markets. And so we put the deal together, put together a consortium of investors. And since then, it's been a really great run. A tremendous operating team, management team there. We've put together a lot of organic growth projects within the company. And as we started to think about where we were, we'd returned a lot of capital, accomplished a lot of what we set out to do, and then saw the valuations rise at the beginning of the past year of 2024, which I really think was a lot of people coming into power stocks as a way to play AI. And that started getting us thinking about an exit. And so we looked at that in two ways. One was looking at a potential IPO. We think Calpine would have been a very viable IPO. But along that path came some potential strategic investors. We had long admired Constellation, loved their strategy, think they're really well positioned for what's going on. So the chances to join two great companies together was just a great opportunity for us.
Certainly a lot of people are watching Constellation as a play on the AI trade already. But this would make it having the largest fleet of U.S. power stations. What does that mean in terms of the ability to capitalize on the AI boom? And are there complications? Just yesterday, Larry Fink was at Davos talking about how local units here are very concerned about the power needs that will go to AI rather than to homes.
Yeah, I mean, that's the challenge we're facing here. We are facing unprecedented demand. We think we're going to see close to 3% annualized demand growth. This is coming off of 15 years of basically zero electricity demand growth. So we have all this demand growth coming. The markets are already tight from a supply-demand standpoint. And so there's a major challenge here of how do we meet this growing demand and keep a viable system of reliability. And reliability will always be sort of job number one of the electricity industry. I think Constellation not only is the largest, but it's the type of assets they own, especially now with Calpine. They own the largest fleet of nuclear, the largest fleet of gas-fired assets, the largest geothermal asset, and that's the type of power we need to meet this demand, because the demand that's coming from AI is 24/7 around-the-clock demand. So nuclear assets, gas-fired assets, geothermal, those are the kinds of demand, power supply we need to meet those demands.
So investing in power, let's also talk about data centers as well, because in October, you announced a $50 billion partnership with KKR to invest specifically in data centers and support AI growth. Just talk to us about the opportunity set there, because there's certainly a lot of excitement around that area.
Yeah, and you see, I mean, the numbers that are being thrown around are incredibly large. These are huge projects. When we talk about a gigawatt of power, we're talking about something like $15 billion of capital across power and data centers.
Still not quite sure what a gigawatt is.
We had a huge argument about this yesterday.
We had to do some
Sorry, a gigawatt, 1,000 megawatts.
15 billion per gigawatt?
Sorry, 1 gigawatt of power, so 1,000 megawatts. That would cost roughly $1.5 billion.
Okay.
But the associated infrastructure across the data center, computing equipment, all that, that's what gets us to sort of $15 billion.
That's hugely clarifying.
Yeah, sorry.
Matt Miller is watching.
There is a lot of jargon in this industry, so I apologize. And so very large projects. And so as we thought about meeting that, we knew we were going to have a place in this equation either way, because we're a leading investor across the power industry. But for us to have a chance to partner with a leading player in the data center side, who's well capitalized, like KKR, who's been a terrific partner, was a great opportunity for us to go to the hyperscalers with sort of a one-stop shop of a leading data center company, a leading power provider, and go after very large projects that, as you hear the numbers, 10 and 15 billion. You saw the Stargate announcement, 100 billion. The numbers are kind of mind-boggling. So we wanted to really form a JV that would allow us to be at the front and center of these large projects coming.
Yeah, the numbers really are mind-blowing. And you think about just yesterday, G42 was speaking alongside Larry Fink, and they said there's going to be a global need for 200 to 300 gigawatts. And that's a conservative estimate. He then put this is where the 15 to 20 billion discrepancy came in. We thought it was just 1 to 2 billion, but yes, it's actually a lot more. That brings you to $15 trillion of capital needed to fund this AI boom. Where does all that money come from?
Well, you're seeing the largest companies in the world, the hyperscalers, making incredibly large commitments. I do think with the focus of all this, the capital formation is going to improve a lot in this sector, because it's just, I think it's the number one thing going on in the U.S. economy, and it's going to attract a lot of capital. It's not all going to happen at once. These are complicated projects. There's a lot of planning involved. Coordinating the power supply with the data center build out is going to take time, land. It's going to take cooperation across a lot of parties to make these happen. So this is not all going to happen at once, but there is a bit of a race going on, and so we'll see. And I think the 200, 300 gigawatts is actually probably a small, a light estimate. That's just demand growth alone. There's that much. There's also supply going away in the form of coal generation that we have to replace. So there is, this number could be more like 500 to 700 gigawatts.
And I want to correct myself, because I think I said 15 billion. It's 15 trillion.
Oh my God.
And so that's just the scale we're looking at.
I'm going to try to get us away from the gigawatt conversation.
Yeah, billions, trillions.
I'm going to get myself in trouble. Let's go back to what we were talking about with Calpine. It was really interesting to hear that, you were thinking about an IPO, but went for a sale here. I have to imagine there's plenty of folks in the industry in shoes such as yours looking for an exit here. Do you think that will tilt more towards the IPO market or more of these M&A type transactions?
Yeah, I think what we're entering into a period where I think there's going to be a very robust period for deals in private equity is that we are going to see both a strong M&A market and a reopened, stronger IPO market. And so I think that's what really creates a good competitive tension to get to a great outcome. When you're selling a company as large as Calpine, you don't have a lot of options to go to given its size and scale of where to go. So an IPO needs to be on the table, and now we have a healthy market. And that helps to draw out strategic buyers who look at it and say, this may be my time to do this deal, or it's going to be public and I may not have that chance later. So I think we're going to see a lot of both. And I think in the past few years, we've been limited by not a very healthy IPO market.
I want to go back to the broader picture here, because one of the first campaign statements here that came out of the president's campaign was drill, baby, drill.
Yeah.
But when investors look to the energy market here, are they missing something? Is it not those traditional oil companies that are going to be doing so well? Is it going to be these new era energy companies that are perhaps going to be doing better?
Yeah, when we talk about power and meeting the data center needs, oil does not have a lot to do with it. Natural gas is going to play a big part in it. Nuclear is. Renewables are still going to play a big role in it. Oil is kind of separate from that. So
yesterday's news.
Well, as it relates to AI, the AI build out, it's yesterday's news. I think that's going to take a lot of natural gas, which we have a lot of in this country, and we're going to see a lot of new natural gas come on, continue to use nuclear, maybe more nuclear down the road, and renewables. That's how we're going to meet that challenge. So the drill baby drill as it relates to oil is not a particularly important part of this equation for meeting the AI and the demand growth in the country.
Just fascinating to watch this industry change. Great to spend some time with you as well. Our thanks, of course, to Tyler Reeder of Energy Capital Partners.
Thanks for having me.
Meanwhile, let's get a look under the hood of what the stock market is doing right now. We'll do that with Bloomberg's Jess Menton.
Well, Katie, taking a look at Electronic Arts here, it's the worst performer in the NASDAQ 100 as well as the S&P 500. Unfortunately, when it looked at its net bookings on an annual basis, it's coming in lower than expected, especially because we actually are getting its earnings until February 4th, but you see that stock down 17%. So if you're looking at the S&P 500 entertainment group, it's actually flat for the day just because Netflix is also housed in that particular group. And obviously it had a tremendous session yesterday and adding to those gains today. But if you're looking at other stocks in that space, when it comes to gaming like Take-Two Interactive, that's down as well. Other stocks I'm keeping a close eye on, though, especially when you're thinking about what's happening with Dow Transports and companies housed in that, because that can tell us a lot about the trajectory of the economy. You have moving in different directions here. You have American Airlines actually lower today on the back of obviously the lower than expected, especially the loss that it was projecting in the first quarter. But again, at the beginning of December, it expected a better than expected fourth quarter. And of course, if you look back at other airlines like Delta, as well as even Southwest and JetBlue were expecting better than expected profits for the final travel months here. But a lot of that is more unique to American Airlines just because of some of the travel type things they were trying to do with some of its partners there. But it actually does have a deal with Citi that analysts are expecting could potentially help this out. And then, of course, if you're looking at Union Pacific, actually that's a stock that's moving higher on the back of its earnings reports. You're seeing things moving a little bit directions here. So a lot of that pressure we would have seen in Dow Transports at the end of last year was pressured more so when it comes to the railroad. So we are seeing that recover at the beginning of this year. And then lastly, I wanted to point out a stock. It has a less than $1 billion market cap. It is housed in the Russell 2000. It's Marine Max. So this is a boating and yacht type company. It can tell you a lot about the direction of the economy, down about 50% from its high during the peaks during COVID here. But actually, you're seeing it pop on here, better than expected margins despite some disappointing issues when it comes to the sales side of this. And it stocks up over the last 6 years, close to about 90%, guys.
Jess, we thank you so much for breaking it all down for us. That is Bloomberg's Jess Menton. And President Trump is set to address the World Economic Forum virtually at the top of the next hour. We're going to preview his much anticipated speech. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And the Los Angeles wildfires could be the costliest in U.S. history, with J.P. Morgan estimating more than $20 billion in insured damages covered. David Weston spoke with R Street Institute's Jerry Theodoro and Swiss Re's Monica Ningen about the insurance industry's ability to cover those losses.
This is speculative and shifting day by day, so we're not sure exactly where it's going to land. But the insurance industry that have looked into this and looked at the impact on their book are not running for the hills.
Jerry Theodoro is director of the Finance, Insurance, and Trade Policy Program at R Street Institute, a DC-based think tank that promotes free markets. Like Theodoro, S&P Global Ratings says the insured losses from the LA fires should be manageable. In part, that's because it's not just the primary insurance companies bearing the losses, it's also the reinsurance companies that back them up.
Estimated insured losses are $20 to $30 billion, and reinsurance is going to take a big piece of that, risk that's spread all over the world. Bermuda, London, continental Europe, the Far East, reinsurance companies taking a piece of the pain. So a big company like the Farmers, which is the second largest insurer in California for homeowners, has got over 100 reinsurers on its reinsurance panel.
As the ones insured, homeowners are the first step in a ladder of risk that starts with individuals or businesses, goes up to insurers, then to reinsurers, and ultimately can hit investors or even taxpayers. With each step, the risk is calculated, changed, repackaged, and spread around. But one thing we know for certain, it never goes away. Instead, it's increased, and with it, the premiums have also been on the rise.
It's a tragic event, and it's one that the insurance industry, I think, is prepared to deal with because of this incredible distribution of risk. I mean, think about having 100 reinsurers on your panel. You know, Lloyd's syndicates, big guys, big reinsurers in continental Europe, Bermuda, the reinsurers there, some U.S. insurance, Korea, China, other countries too that have got reinsurance companies that take a bite out of the apple of a company that is ceding its risk to the reinsurance market. So that it pays up to a certain amount. This is the most that we're prepared to lose.
Swiss Re is a global reinsurance company, and our clients are insurance companies. We partner with insurance companies to protect their balance sheets.
Monica Ningen is CEO of U.S. Property and Casualty Reinsurance at Swiss Re, one of the largest reinsurers in the world.
When it comes to reinsurance rates, there is an impact from climate change, but it's relatively small. The other factors being economic inflation, wage inflation, inflation of construction, plays a big factor, especially in the last few years.
And that was Jerry Theodoro and Monica Ningen. You can catch Wall Street Week every Friday at 6 p.m. Eastern. Meanwhile, quick check on these markets right now. The S&P 500 briefly turning positive. Of course, we've been flirting with losses all day. You can see the tide is turning a little bit. The S&P 500 up by, you can round that up to 0.1%. The NASDAQ 100 still lower on the day. We know we've seen some pain when it comes to your big tech names, currently down about 0.3%. But you do have Apple making a run for it right now, up about 0.9%. That is your biggest points contributor to the upside for the S&P 500. General Electric not too far behind. And the bond market, keep an eye on this one, guys, because the 10-year Treasury yield currently higher to the tune of about 4 basis points. You're sitting at 4.65.
Just incredible. We were talking about how 4.60 alone was kind of stunning. S&P 500 only less than 4 points, I believe, 4 points away from another all-time high. Let's see if these gains can hold.
All right, this is Bloomberg.
Now, President Trump has been the talk of Davos this week. He's not there in person, but he is set to address attendees by video in just a few minutes. The CEOs of Blackstone and Bank of America are among the people who will pose questions to the president. Let's go to Kaylee Lyons, co-host of Balance and Power. She's in Washington for a sense of what to expect. I just go back to the last time that we saw Trump in Davos in person. And of course, he did really capture the attention of everyone there. A lot of people hinging on what might change. I can't imagine that the tariff question won't come up a lot from these CEOs.
Well, they may ask tariff questions of him, Sonali, especially considering the way in which tariffs could impact global economics, which could have a direct impact on many of their businesses. But he may well bring it up himself in his remarks, as we have seen him do frequently since his inauguration on Monday. He has not been shy in addressing the cameras, talking at length about his economic policy, tariffs inclusive of that, as well as tax cuts he would like to pursue. And he's engaged a few times already with the press in question and answer sessions. So he certainly has gotten used to this again in the last few days, but it is going to be interesting to see if they can get him to get more specific, because Donald Trump initially suggested he was going to come into office and could immediately put, for example, blanket universal tariffs on every import into the United States. To this point, and it's day 4, that has not happened. He's merely suggested that February 1st could be a day, and I would stress could, that we see 10% tariffs implemented on Chinese imports and 25% tariffs implemented on Mexican and Canadian goods. All that said, that is definitely a far cry from implementing universal tariffs, and markets do seem to have liked this idea that he's taking this slower and seemingly in a more targeted manner than may have been expected. But it'll be interesting to watch his language on this when pressed by people who are in the know about the economic impact this would have later today.
Yeah, Kaylee, I have to say I'm pretty excited to watch this one, scheduled for 45 minutes. Really interested to see what kind of questions we get from the likes of Steve Schwartzman and, of course, Brian Moynihan here. This is an international audience, though. Of course, we're talking about the World Economic Forum in Davos. I mean, what has the reception among global world leaders been like to the first 4 days or so of the Trump administration?
Well, certainly everyone is trying to keep ties warm with this administration. Katie, it's definitely different than when he was leaving office 4 years ago, and people were much more willing to be critical of actions around the 2020 election or the early days of 2021 with January 6th. Now we have seen both world leaders knowing they have to interact with this administration in a diplomatic sense, and business leaders knowing that his decisions could impact the trajectory of these different corporations have tried to warm up to him, evidenced by, at his inauguration, a suite of tech CEOs having better seats than many of his own cabinet nominees. So it'll be interesting to see whether or not this really does get contentious. I would expect for some of these businesses, like Bank of America under Brian Moynihan or Patrick Pouyanné of Total Energy, deregulation might come up as well, because he has talked a big game about deregulating a lot of industry in the United States, making sure that permitting is easier, that there's all sorts of regulatory reform to ease the burden on companies. And they might want details about that, too. All of that said, of course, it comes at a time when basically all of the global elite gathered at Davos, who has had no choice but to talk about Trump in the last few days, has done so perhaps a little bit more favorably, knowing that Donald Trump himself is likely watching.
I also want to point out that coming into this administration, there was a big sense here that you would see deglobalization, perhaps, or at least a lot more nationalist sentiment. But then just this morning, you have the Saudi crown prince making a $600 billion pledge to the president, and he also said he wants to expand trade with the United States. So this idea of trade perhaps is more closed off to some areas than others. What does that money come with ultimately? Because it's not the first set of investments we've seen come from the Middle East, particularly when you think about the role of prominent Abu Dhabi investors with the AI initiatives here in the United States.
Yeah, that was one of the first investments announced at Mar-a-Lago in the intermediate period between Trump's election and ultimately, of course, his inauguration, was this money coming in from the Middle East and real estate development, specifically focused on AI infrastructure. And we got another development on that just earlier this week when Sam Altman, Larry Ellison, and Masayoshi Son all were together at the White House with Donald Trump, announcing what could end up being a $500 billion investment into artificial intelligence infrastructure. And all of them saying that they would not be making those decisions had Donald Trump not been elected. The idea that the U.S. is going to be a friendlier environment to business. But to your point, Sonali, on trade, we do know that Donald Trump views many of the trade relationships the United States has with other countries as inherently unfair. That is why he is so favorable around tariff policy, trying to recalibrate those relationships in a way in which he sees as more favorable, in addition to the revenue generating effect that he would like to see tariffs have. And of course, this external revenue service he wants to create to help offset some of those tax cuts. I would just note as well on the geopolitical sense that something else Donald Trump could talk about today and something that many global leaders are watching is commentary around the war in Ukraine, especially after Ukrainian President Vladimir Zelensky yesterday talked about U.S. peacekeeping forces potentially, and Trump himself is pushing Vladimir Putin to come to the negotiating table.
All right, Kaylee Lyons, great preview. That, of course, is Kaylee Lyons. She is the co-host of Balance of Power in Washington. And make sure to stay tuned for Trump's speech, expected and scheduled to start at the top of the hour at 11 a.m. New York time. Meanwhile, coming up tomorrow on Open Interest, rounding out the trading week, Causeway Capital Management CEO Sarah Ketterer and Ann Berry of Threadneedle Ventures join the show. This is Bloomberg.